Hi and welcome to Swissquote's Daily Market Talk. It's Monday, October 27th. Market mood is well optimistic this morning after last Friday's CPI data showed that inflation in the US advanced less than expected by analysts in September, paving the way for the much expected rate cuts from the Federal Reserve, the first one scheduled for this Wednesday already. And other than that, news that the US and China are now inching closer to a trade deal helps investors take on more risk this Monday. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So another week of trading starts on a positive footage on the back of a variety of news that please investors. The first one of them being the US inflation data that landed last Friday after weeks of official data drought in the US due to the US government shutdown that is still going on. So there. The data on Friday showed that the headline inflation in the US advanced to 3% in September. So this is the highest level since Donald Trump entered the White House, mind you, and way above the Federal Reserve's 2% inflation target. But the figure was lower than expected and lower than penciled in by analysts, and the core inflation in the US retreated from 3.1% to 3% during the same month. So despite the unpleasing nature of the absolute figures, the fact that they were softer than expected by analysts cemented the idea and the expectation that the Fed will sure deliver a 25 basis point cut when it meets this week, and there will probably be a third rate cut from the Fed in the month of December with a 93% chance assessed to it this Monday morning. As such, the US dollar and the US 2-year yield, which captures the Fed expectations, were under pressure on Friday, but they are both higher this morning at the time I'm talking here on improved risk appetite across the globe due to optimism that the US and China are now inching closer to a trade deal. Early reports this Monday actually indicate that the two sides have reached an initial agreement on major talking issues, and that includes export controls, shipment levies, and fentanyl. So that basically means that this Thursday's meeting between the US President Donald Trump and the Chinese President Xi Jinping could be promising. As such, the CSI 300 index in China is up by around 1% at the time I'm talking here, also supported by the data showing slowing contraction in foreign direct investment in China and also improved industrial profits among the Chinese companies. In the US, the combination of softer than expected CPI figures, the expectation of 2 more interest rate cuts from the Federal Reserve, and trade optimism is pushing the S&P 500 to fresh all-time high levels. So that was the case on Friday again, and the futures are pointing at a bullish start to the new week. The earnings season, on the other hand, for the S&P 500 companies is going quite well as well. Around 30% of the S&P 500 companies reported their earnings so far, and 87% of them reported a positive EPS surprise, and 83% of them printed a positive revenue surprise according to FactSet, and the blended year-over-year earnings growth rate for the third quarter is 9.2%. It would mark the 9th consecutive quarter of earnings growth for the index, so that's also higher than around 5 to 6% earnings and revenue growth expected broadly by analysts according to Zacks. So this week, the technologies heavyweights, so that's including Microsoft, Google, Meta, Apple, and Amazon. So these companies will be reporting their own third quarter results throughout this week. And because they make up to 25% of the S&P 500's total capitalization, and because they spend huge amounts in AI, and because they are shouldering the market rally that's been unfolding since the beginning of 2023, and that despite wars and rate hikes and inflation and economic difficulties, well, their results are extremely important in determining whether the major and the technology-heavy US indices deserve to extend this rally further. So investors want to see one, concrete payoff on their AI investments. Two, well, growth trend of data centers, for example, and other AI related businesses. And three, pledge that they will keep spending the roughly, because well, spending of one company here is the revenue of the other company. That's the circularity of this AI play. And among these companies, Meta and Amazon are expected to print the biggest percentage change compared to last year. For Meta, this is actually due to its AI-led revenue growth, but also this heavy cost-cutting program. They actually reduced their headcount by about 20% since last year, so that's actually helping. And for Amazon, well, the expected surge actually owes more to weak base effects and a return to margin discipline in this company. Costs are now rising more slowly than their revenue, and that pleases investors, while the high margin cloud and advertising units continue to expand. So voila, we can't wait to see the results. We will be commenting them as we go on. But on Friday, Intel was up 8% pre-market after its earnings beat expectations, but all of the enthusiasm melted like ice under the sun as Intel's status of assisted company today sits on the back of every investor's mind today, obviously, because the US government that has 10% stake in Intel wants Intel to re-become the tech champion that it once was and shoulder Donald Trump's dream of bringing the chip manufacturing back to America. So the letter is actually and concretely leading to, well, deals with AI giants like Nvidia and SoftBank, for example, in the context of this Stargate project, and news that surround Intel gives way to price jumps here and there for the company. But Intel makes more sense from a political point of view today than from an economic play. So I continue to believe that the US support, this ample support, will keep Intel going for a while. But whether this whole saga around Intel will lead to sustainable and viable growth of the underlying business is yet to be seen. Bringing manufacturing back to the US is not as easy as it sounds. Elsewhere, the SOX 600 index and Nikkei hit a fresh all-time high level since we last talked as well. In Europe, it set off better than expected PMI figures last week, and the dovish Fed expectations that actually improved the global risk-taking will help sending the SOX 600 index to an all-time high level last Friday. And this week, the early CPI estimates from the European countries for October are expected to hint at a slight retreat in inflationary pressures for this month, and that's really positive for ECB expectations, while the ECB itself is widely expected to maintain its rates unchanged when it meets this week. And there in Japan, well, Takaichi's push for softer Bank of Japan policy, which would mean softer rate hikes and higher government spending on technology, defense, nuclear, and cyber security, actually backs the Nikkei's exponential rally today. The dollar yen extends gains to 153 this morning as well, with potential to reach the 155 to 160 level without too much hesitation. So Nikkei is supported by all that, while the euro dollar remains under the pressure of French political shenanigans. Moody's last Friday maintained France's credit rating unchanged, but they revised its outlook to negative from stable. And, well, the Social Party in France warned that they could bring this fragile French government down as soon as this week again. So voila, the widening spread between the French and German 10-year yield will likely keep the euro dollar below the 50-day moving average this week that currently stands near the 116.90 level. And in the UK, last week's data was unusually optimistic. Headline inflation there unexpectedly eased to 3.5% level, but retail sales surprised to the upside for the fourth straight month, which is kind of inflationary. So the letter left the Bank of England debate on future rate cuts pretty blurry, but in all cases, sterling remains unappetizing into the autumn budget announcement of next month. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
This content is intended for individuals who are familiar with financial markets and instruments and is for information purposes only. The presented idea, including market commentary, market data, and observations, is not a work product of any research department of Swissquote or its affiliates. This material is intended to highlight market action and does not constitute investment, legal, or tax advice. If you are a retail investor or lack experience in trading complex financial products, it is advisable to seek professional advice from a licensed advisor before making any financial decisions. This content is not intended to manipulate the market or encourage any specific financial behavior. Swissquote makes no representation or warranty as to the quality, completeness, accuracy, comprehensiveness, or non-infringement of such content. The views expressed are those of the consultant and are provided for educational purposes only. Any information provided relating to a product or market should not be construed as recommending an investment strategy or transaction. Past performance is not a guarantee of future results. Swissquote and its employees and representative shall in no event be held liable for any damages or losses arising directly or indirectly from decisions made on the basis of this content. The use of any third-party brands or trademarks is for information only and does not imply endorsement by Swissquote, or that the trademark owner has authorized Swissquote to promote its products or services. Swissquote is the marketing brand for the activities of Swissquote Bank Limited, regulated by FINMA, Swissquote Capital Markets Limited, regulated by SISEC, Swissquote Bank Europe SA, regulated by the CSSF, Swissquote Limited, regulated by the FCA, Swissquote Financial Services Limited, regulated by the Malta Financial Services Authority, Swissquote MEA Limited, regulated by the Dubai Financial Services Authority, Swissquote PTE Limited, regulated by the Monetary Authority of Singapore, Swissquote Asia Limited, licensed by the Hong Kong Securities and Futures Commission, and Swissquote South Africa Limited, supervised by the FSCA. Products and services of Swissquote are only intended for those permitted to receive them under local law. All investments carry a degree of risk. The risk of loss in trading or holding financial instruments can be substantial. The value of financial instruments, including but not limited to stocks, bonds, cryptocurrencies, and other assets, can fluctuate both upwards and downwards. There is a significant risk of financial loss when buying, selling, holding, staking, or investing in these instruments. Swissquote makes no recommendations regarding any specific investment, transaction, or the use of any particular investment strategy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. The vast majority of retail client accounts suffer capital losses when trading in CFDs. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Digital assets are unregulated in most countries and consumer protection rules may not apply. As highly volatile speculative investments, digital assets are not suitable for investors without a high risk tolerance. Make sure you understand each digital asset before you trade. Cryptocurrencies are not considered legal tender in some jurisdictions and are subject to regulatory uncertainties. The use of internet-based systems can involve high risks, including but not limited to fraud, cyber attacks, network and communication failures, as well as identity theft and phishing attacks related to crypto assets.